If you're a U.S. business owner who's figured out how to make money, let me tell you something. Big changes are here for 2025. And if you don't take action now, you could be leaving millions on the table. You see, the estate and gift tax exemptions, they just increased. But here's the catch. It won't last forever. All right, let's break it down. As of January 1st, 2025, the federal estate and gift tax exemption, along with something called the generation skipping transfer tax exemption, has increased to $13.99 million per person. That's up from $13.61 million in 2024. What does that mean for you? Well, if you're a married couple, you can now shield up to $27.98 million from taxes with the right planning strategies in place. Now, you may say, well, wait a minute, Edward, that's a lot of money. This doesn't apply to me. Well, I have two things to say on that front. First, if you haven't figured out how to build real wealth yet, you may be right. This may not necessarily be the best video for you to watch at the moment, but I'm going to direct your attention to understand that a lot goes in to what's includable in your taxable estate. Brokerage accounts, your checking accounts, your savings accounts. It even includes your retirement accounts. And your real assets, like your personal residences and your vacation homes, even your rental properties. It also includes your businesses and possibly even your death benefit of your life insurance if you haven't structured things just the right way. But here's the kicker. These increased exemptions that I mentioned for the 2025 year, well, they're set to expire on December 31st of this year, 2025. And the limit, that's set to fall back down to just $5 million, adjusted for inflation. So if you wait too long, you might miss out on an opportunity to transfer wealth, significant wealth, tax-free. Another key change, the annual gift tax exclusion, that's also gone up from $18,000 per year to $19,000 per year per recipient in 2025. This is an easy way to start transferring wealth tax efficiently to family and other loved ones each year. And for those of you with non-citizen spouses, now you don't have a lifetime exclusion that you get to use there, but you can have an annual exclusion that's much larger. You see, the annual exclusion when we're talking about non-citizen recipient spouses, well, that's increased from $185,000 up to $190,000 per year. Now, it's important to remember that gifts between U.S. citizen spouses, that remains unlimited. But strategic planning is crucial when dealing with non-citizen spouses. Now, estate tax itself isn't just a federal concern. There are several states that have their own estate and inheritance taxes. And those rules you need to be aware of. Let's take a quick look. See, let's talk about those states with no estate or inheritance tax. We have Alaska, Arizona, California, Florida, Indiana, Nevada, North Carolina, Ohio, South Dakota, Texas, Utah, West Virginia, and Wyoming. Now, when it comes to just estate taxes, well, we have Connecticut, Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, New York, Oregon, Rhode Island, Vermont, and Washington. Now, there are a few states that just simply have an inheritance tax. That's Iowa, Kentucky, Nebraska, New Jersey, and Pennsylvania. And Maryland is the only state that has both an estate and an inheritance tax. So if you're in any state that imposes estate or inheritance taxes, it's critical that you factor these into your wealth planning strategies as well. A quick but important update on retirement accounts is also necessary because if you've been tracking like RMDs, required minimum distributions, it's important to know that the required age has now increased to 73. And from the future itself, it's looking to move that minimum age for required minimum distributions up to age 75 if you're born after 1959. Again, that's something that's planned. It's not currently in place. So 73 is the current age. And the reason why this is important is just like I said earlier, your retirement accounts could be included and are included in almost every circumstance in your taxable estate. This is a great opportunity to start revisiting your retirement strategy overall and make adjustments as necessary, right, accordingly. You can incorporate like beneficiary planning. There's so many different things to do there. So I don't want to gloss over too much on the retirement planning side of the spectrum. But overall, here's the bottom line. The clock is ticking. So whether you're maximizing gifting opportunities or leveraging the current exemption amounts or simply structuring your estate for tax efficiency, now is the time to act. If you're serious about protecting your wealth and building a legacy, my team and I are here to help. We specialize in guiding business owners through complex financial and estate strategies, ensuring that you take full advantage of all of the opportunities available. So don't wait until it's too late. Click the link in the description below, fill out a quick questionnaire just to see whether or not we may be a fit to help. See you on the next one. Bye for now.